Hi class, welcome to Chapter 6, Industry Analysis. Okay, some of the objectives from this chapter: explain the phases of the industry life cycle, relate dividend policy to life cycle. That has something to do with the way as a company grows, where we allocate our cash, right? Inside the business again or out to shareholders. Describe the various economic structures of the industry. Explain the effect that government regulation can have on an industry. Describe how to compare the performance of many companies within the same industry. Explain the concept of rotational investing, in which the investor shifts emphasis among industries during various phases of the business cycle. Okay, so industry analysis is comprised of four things: the industry life cycles, industry structure. The book talks about an example from the pharmaceutical industry, which we can dig into, and I can give you some thoughts in addition to what the book says on that. Industry groups and rotational investing. Okay, so industry life cycles are created because of economic growth, competition, availability of resources, and the degree of market saturation. Okay. I asked you a question on the homework about industry life cycles versus product life cycles. How they're different. Product life cycles have 4 stages. Industry life cycles have 5 stages. We go into that in a little more detail here. Then also talks about dividend policy and the life cycle curve. Okay, so here's the 5-stage industry life cycle. There's the life cycle curve. So stage 1, it says no cash dividends. Stage 2, stock dividends. Stage 3, stock dividends and splits. Stage 4, high payout ratio. And then stage 5 is high dividend payout ratio, and then no dividends. What are they doing here? Well, stage 1, they're accumulating cash, reinvesting into the business. Stage 2, they're starting to pay off some investors with dividends. Stage 3, more aggressive in dividends. Why is this happening? Well, no matter how great a company is or big a company is, it becomes more and more difficult to find profitable ventures. So what happens when you've gotten so big? You might give a dividend, which is why your investors bought in the first place, so they can get a cut of the action. So the correlating 5 phases there, stages I should say, are development, growth, expansion, maturity, and decline. Okay, so development stage. Companies are getting started with new idea, product, or production technique that makes them unique, usually privately owned and financed with owner's money, as well as capital from friends, family, or a bank. Okay, if successful, may attract venture capital. So venture capital may come in and infuse your business with money. Sometimes a lot of people have a lot of great ideas for businesses, and the main problem to doing it would be cash. Being able to I think I could run a great restaurant. Why don't I open up a restaurant? Well, I just don't have the cash to do so. Okay. Pays no dividends because all profits are reinvested into the firm. Risky investment with large potential return. Okay, so that's like you're buying a startup. That's what I would, best correlate development stage with. Think about startups, right? Stage 2, growth. Industry or company that has achieved market acceptance for its products and services. Retains earnings for investments. Sales and returns on assets growing at an increasing rate. So you're more established at this point. You're becoming profitable. Pay stock dividends to preserve capital. Okay, so you'll pay dividends on some stocks. Pay low cash dividends as the need for new capital declines as sources of capital appear. I believe the book refers to this as the crossover point. Risky investment with large potential return. Okay. Oh, sorry, crossover point. That's in stage 3, expansion. Sales and earnings continue expanding, but at a decreasing rate. The crossover point, a change from accelerating growth to decelerating growth. Also, limited dividends to high dividends. All right. Conversely, more competition enters the market. Once you have a successful idea, let's say we live in a limited town and we open one burger restaurant, and that burger restaurant starts out small, gets bigger, becomes a huge thing. what is someone else likely to do? Well, open a Burger King near McDonald's, and try to capture some of that market. Because if you're the only game in town, you're going to have a huge advantage in terms, you can charge whatever you want. You're the only game in town, things like that. So anyway, moving back to this, cash dividends increase in dividend payout ratio, stock dividends and splits still common. I asked you about stock dividends in the payout ratio in particular, I believe in the homework, so pay attention to that in the reading. Stock prices may decline as investors realize growth rates will be declining, right? So, what's the value of an investment really? And this is, touched base on throughout the book. It's the present value of future income. Is really what the worth of the investment is, or perceived future income is probably a better definition off the top of my head. So when you realize that there's going to be less growth, then the stock will start to decline. Think about Apple. Apple's gotten so big. Think about is there more upside or downside to them? I don't have the best answers because I haven't done the research. But same thing with Walmart. They've gotten huge. How much bigger can they get, right? They'll probably more likely than not become stable. Although you can look at Walmart and with competitors like Amazon and things like that and say, can Walmart maintain such a dominant position? But anyway, moving on. Crossover point. So we see price to earnings ratio and stock price are higher, right, under the growth period, and then decline during expansion, and then further, continuing decline in maturity and the decline phase. Okay, why is that? Well, what is price to earnings ratio? Okay, it's a growth indicator, and you guys should make sure you do the reading to get better details on that. But it's important to know, and this goes into more details with the the homework and the questions I asked you in the discussion board. But some of these concepts I want you to read through to have a great understanding of them. Okay. But price to earnings, it's, the definition of it, it's pretty much in the name. So, knowing the formula, being able to memorize a formula is not as effective as understanding what the formula really means. So, make sure you do the reading and understand that. Maturity stage, 4. Industry sales grow at a rate equal to the economy as measured by long-term GDP. Plant and equipment are in place. Okay, financing alternatives are available. Right, you have great credit, you're in the mature stage, okay, it's easy for you to get capital from multiple sources. CFO, or cash flow from operations, usually sufficient to meet growth requirements, so you have cash on hand, you can buy things, you don't have to get loans. Dividends may range from 40 to 50% of earnings, so half of your earnings, net, you're paying out to shareholders. Why? Because you don't have anywhere else better to put it besides in your shareholders' hands, okay, and now, since your dividends are so high, a lot of the value of your stock price is now based on your dividends. So, changing your dividend policy, could be, damaging, right? So, let's say we cut dividends and instead of paying out 50% of our dividends, we're like, what, we need money for this new project. We're going to cut our dividends down to, 25%. Dramatic cut, right? Now, is that positive or negative? Well, there's no right or wrong answer here. One reason that could be a positive signal is if the market, which is the overall investors, believe that the cut in dividends will create more growth by whatever we're investing that money that we're not paying you guys out into. So if that's perceived by the market as a successful venture, prior to it occurring, then, it will be perceived as a positive. Now, if that cut in dividends, the market doesn't believe we're, pouring that money that we took out of shareholders' hands into something that's going to create long-term growth, then there'll be a pessimistic view and the stock price could drop because, present value, future income, whether it's a dividend in the hand or a high growth project that's, forecasted to be very, very profitable. A lot of it has to do with market expectations, and that gets factored in as well. Okay. Oh, I was just saying, last one here, often compared to growth rate of the S&P 500. So large companies grow at the rate of the S&P 500. that makes sense, right? So, very rarely, if we had an average of the top 30 biggest companies in the S&P 500, they would actually statistically fall pretty close with this line. Same thing with GDP. So these companies are just, being stable. They're almost, what I would call growing with inflation. Walmart might grow 3% a year, but McDonald's might grow 3% a year. And that is mostly due to just, inflation. We're not talking about 3% more stores. We're talking about net profit that might go up 3%. But, it's an average. So, one company might do better than the other. And, it's not always perfect in terms of, how everything's distributed. Okay. Also saying gas and electric utilities move along with GDP. That makes sense too. Gas, electric, if the economy goes up, they charge more prices, higher demand for gas and electricity, right? Economy goes down, what happens? Well, lesser demand for gas and electricity. Okay, so the price of that stuff falls, and their profit then falls. Okay, decline stage, industry suffer decline in sales of product. Innovation has not increased product base over the years. May be specific to a country. Industry may undergo might be consolidated. Weakest companies fail. Bankruptcy, dividend payout ratios sometimes rise to 100% or more of earnings, followed by drastic cuts. So, a company rarely does this happen though now. Might just say, all right, we're going to liquidate, kind of pay out everything in dividends. That usually doesn't happen depending on the circumstance of the structure of the company. So growth in non-growth industries. Growth companies may exist in mature industries. So when we're looking at, a top-down view of a stock and say, all right, well, this is the industry. It's a bad industry, but we're going to pick some winners in this bad industry to outperform the market when we're doing some kind of active investment. So not all firms within an industry experience the same growth path in sales, earnings, and dividends. Perfect example right now, Apple, right? Look at Apple, Apple's stock price compared to the average, computer price, right? Computer stock, right? Apple's crushing it, They won't do that forever, but, if the PC industry is overall down, Apple's way up. So, when you look at the benchmark for those companies, computer firms, it might look higher than it really is because Apple is actually dragging up the price, or the average of that industry. Some mature firms might be good investments, growth by expansion abroad, international demand greater than domestic demand, utilities in areas of rapid population growth. So utility companies here can be considered safe, because they're stable and not going anywhere. But if you invest in I don't want to disparage a country by saying they don't have enough infrastructure. But let's say somewhere in like Brazil where they're still putting in more electric lines and more high-speed internet lines. A country like that, a utility company might be a riskier venture and a more profitable venture. Okay, industry structure determines potential profitability of firms. Special considerations such as government regulation that positively or negatively impact the industry, cost advantages and product quality that may create a dominant company within the industry. So these are things that can shape an industry. So the industry kind of determines some form of the profit capability of that. Government regulations, as we know, can change things dramatically for a company. Cost advantage is obviously pretty straightforward here. If you have a cost advantage, you have some access to some resource or some special production method that your competitors don't. That's a huge advantage, and it will be reflected in price and then your market share. Okay. Economic structure. So we have monopolies, single firm, whole industry. Not common in the U.S. due to antitrust laws. We look at Microsoft was once considered a monopoly. Almost always mature in mature industries. I always think of like Comcast as a monopoly. I mean, most people have one choice of one cable company. You can't get anything else. Where I live, I don't have FiOS, and I'm actually just ranting here. And then you could say, well, it's Dish and all this stuff, monopoly. If it's Comcast monopoly, I should say, is if there's Dish and all that other stuff. Not too sure these are the complex questions that regulators have to, ask. Regulations tend to limit growth and profitability. Okay, oligopolies. I always tell people when they think of oligopolies, think of airlines. Okay, few firms, an open rivalry, common in large mature industries, automobile, steel, oil, airlines. Competition between firms can be intense. Profitability may suffer from price wars. That happens in airlines, and it's always public, when they're having all these sales. Increasingly face international competition, altering their strategies. Okay, pure competition. Many firms, no individual firm has significant market power, not widely found in the U.S. Think about if you started selling corn, right? You grew corn, you went to sell it, right? It's pure competition. No one's going to pay that much more or less for your corn than they would anywhere else in your region, right? Okay. Other economic factors to consider: supply and demand relationships that can drive or cost up or down, availability of raw material, energy cost. Alternatives to your product is also something else. Some industries, as regulation increases, costs and prices can go up. When it's deregulated, in theory, and in actuality, I guess, prices should go down, although there's been some empirical studies that show that's not always the case for some industries, right? Government expenditures, when government, buys stuff, are they buying it from, your company or your industry? That could affect prices as well, okay? Michael Porter's 5 competitive forces. I would know these for homework and a quiz. Threat of new entrants, threat of substituted goods, bargaining power of buyers, suppliers, and then rivalry among existing competitors. These are the 5 competitive forces. This guy's a Harvard professor. Came up with these, theories, and they're pretty spot on in terms of competitive forces in the market. Okay. I won't go into the detail about the pharmaceutical industry example, but think about some things I will mention about the pharmaceutical industry. Some ways, we have the big pharmaceutical firms like Pfizer, right? They're powerhouses, but there's tons of small pharmaceutical firms out there who investing in them is almost like gambling. They develop a drug that's supposed to cure some ailment, and it goes through FDA approval. Which is kind of like, the rubber stamp that lets it go on the market. But they keep it very confidential. And, if the FDA approves the drug, it can mean big bucks for that firm. But at the same time, if the FDA says, no, this drug doesn't work or something's wrong with it or whatever, you can put a place out of business like that. So, interesting business, okay? Patent protection. You have all these drugs that these firms sell, and they have a right to use them for a maximum patent of 10 years. I always thought it was 7, but maybe it's 7 with a renewal period of 3 years. Basically, after that, any other firm can make generic versions of your drug. Okay, and why 10 years? Why not 15? Why not 5? I mean, they just try to come up with an optimal number where it's still profitable for somebody like a pharmaceutical firm to create the drug in the first place and be able to profit on it as an almost monopoly for a certain amount of time. Right? Most life cycle analysis, most large pharmaceuticals and expansion cycles of life cycle. Individual firms go through life cycles as patents expire on popular drugs. Portfolio product life cycles are well diversified for big firms like Pfizer. Okay, industry growing faster than our S&P 500 index. Growth is decelerating; it's slowing down, and a couple other things here. I won't focus on that. I'll let you do the reading. Okay. Government regulation. These firms sell their products throughout the world and are regulated by many governments. Okay, it's still relating this topic to the pharmaceutical firms. So think about you hear in the news that you can buy pharmaceuticals over the counter in Mexico or Canada through an online service. While in the U.S. you need to go see a doctor or 2 doctors, to get just one prescription depending on your health care. So that's an issue of regulation. You can go to some companies and just buy, almost anything over the counter. In other countries, it's more regulated. Tends to be that in the countries where you can just go buy everything over the counter, it tends to be cheaper. Why is that? Well, increased regulation drives up costs, right? Okay, I won't talk about the new healthcare law because I don't think the book talks about it too much, and I don't have a strong enough opinion on it to really talk about it either way. Research and development. Large amounts of money are invested in research and development. So this is what I was talking about earlier. They invest a lot of their time and money into one or two or a handful of drugs that, they're really relying on to work and be profitable for them. Okay. Recent company mergers have created large companies able to pool resources to develop larger economies of scale. Very important for a successful drug firm. It's been the result of large firms who have been unsuccessful at research buying smaller, innovative companies. Okay. Product diversity, very important within the pharmaceutical industry. Unusual to find more than 3 drugs with high market share treating the same problem, right? So you have to be first to market. There's a sickness, you want to be one of the first 3 people with a cure for that. Otherwise, there's no space for you in the market. And that's true for a lot of big things. I could go into details on that, but I won't because this is an online class, and I don't want to ramble on. Within industry, not much direct competition. Usually 1 or 2 drugs dominate the market. Value of a pharmaceutical company influenced more by potential blockbuster drugs in pipeline than by the current offering, right? Because you already know what the current offering is already going to bring in. It's almost a guarantee. The value of the company is based on, there's a 60% chance that this drug will be the first to market on this sickness and then bring in, we think, $60 billion a year, so they factor in all that stuff, the risk, the time value of money, the perceived shots of it going to market and being successful. Patents and generic drugs. U.S. patent issues patents that protect drugs from competition for a limited number of years. After a patent runs out, generic companies reduce profitability. Already talked about this a few minutes ago. Okay. Demographics didn't manage care. As population ages, demand for drugs will grow. So this is just talking about an industry analysis here about how, aging population, going to need more drugs when these people get in their 60s, 50s, 70s, whatever, as, the baby boomer generation ages. Okay. Lastly, rotation investing. The practice of moving in and out of various industries over the life cycle. As business cycle moves from trough to peak, different industries benefit. So, utility companies may be a good firm to invest in during a recession, where at the top of the market, stocks might be technology stocks, or as you're getting to the top of the market, technology stocks may be the one to buy at the top of the market as we're getting to the top. So just know what part of the cycle we're in, which is no guarantee that anyone really knows at any time. There's a perception that we know, but no one really can say this is where we are at this point in time. It's always in 6 months later, 3 months later that you can look back in hindsight and say, oh, this was the whole position of the economy. Okay. And this is just talking about sector rotation. So we have technology, basic industry, staples, utilities, cyclicals, industrials, energy, service, and finance. So it's just talking about the theoretical models based on Sam Soval's S&P Guide to Sector Rotation. He's just a big name in that type of portfolio management. The graph above shows these relationships in order in which various sectors should get a boost from the economy. So they did empirical studies on this and said that, when you're at this part of the economy, this is what you should be buying into. Pretty neat graph, actually. Anyway, that's it for this week, guys. If you have any questions, feel free to email me.